Most traders love trend lines, but here's the truth. 80% of them use them wrong. They draw random diagonal lines and then wonder why the market keeps hitting their stop loss. If you have ever traded a perfect trend line breakout only to get trapped the very next candle, this video is for you. Because today I'll show you exactly how to use trend lines in the right way. Alright, let's get into it. So the first question is, what is a trend line? A trend line is simply a diagonal support or resistance level. You draw it by connecting a series of swing highs or swing lows in a trending market. Think of it like this. Market moves in a waves. Price trends in one direction, then retraces, then continues. When you connect those obvious highs or lows, you create a line that acts as a guide, a visual roadmap of where price might react. But here's the mistake most people make. They trade just like the line. They think price touched the trend line, I'm in. And that's why they get smoked. A trend line alone is not enough. You always need confluence. That could be a key horizontal support or resistance lining up with your trend line, or a price showing a clear rejection candle right at the trend line. That's when the trend line becomes powerful. So the next question is how to draw them the right way. To draw a valid trend line, you need at least two significant anchor points. These aren't random wiggles on the chart. They should be obvious swing highs or swing lows where price moves strongly in the opposite direction afterwards. Now, should you use wicks or candle bodies? Both can work. But here's the key. Be consistent. Don't switch it up just to fit your buys. So now I'll tell you fake breakouts versus true breakouts. Here, where most traders get trapped, the breakout. A fake breakout usually looks weak. The candle around the break are small, lacking energy. Price just creeps above the trend line, tempts trader in, and then reverses hard in the opposite direction. That's the classic liquidity trap. So, what is a real breakout? A real breakout looks completely different. You will see large impulsive candles blasting through the trend line. That's when you look to enter, ideally on the retest of the broken level and ride the momentum. But here's the advanced part most people miss, trend line liquidity. Many traders place their stop just above or below obvious trend line. Smart money knows this. So often you'll see price dip just past the line, grab liquidity and then reverse back in the direction of the trend. That's why context matters more than the line itself. So the key point here to notice is, don't trade trend lines blindly. Look for confidence. Demand confirmation before you enter, and always be aware of fake outs and liquidity grabs. If you apply these principles, you will stop being the trader that gets trapped by trend lines and start being the one who profits from those traps.